US jobs growth was much stronger than expected. The US dollar surged as US Treasury yields jumped 12 to 20 basis points. Expectations for a 50 basis point cut by the Fed next month were reduced. Economists also now see a 50 basis point cut by the Reserve Bank of New Zealand on Wednesday. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, reveals an unusual shift in workforce participation and what it means for interest rates.
That increase in labour force participation has probably been helpful in allowing the Reserve Bank to keep the cash rate in Australia a little below where we saw some of those peaks globally.
But first, in 5 and 5 with ANZ, US jobs data on Friday night was much stronger than expected. That shunted US Treasury yields and the US dollar higher. US stocks also rose around 1%. US non-farm payrolls rose 254,000 in September, when just 150,000 was expected. Here's ANZ economist Bansi Madhavani speaking from London over the weekend.
The September non-farm payroll report surpassed all expectations. The report showed that payrolls rose at its fastest pace in 6 months and unemployment rate fell to 4.1%. What the data point to is ongoing resilience in labour market, and it alleviates any concern that labour market is deteriorating. In terms of what it means for the economy, the preservation of strength in labour market underpins the soft landing narrative, and in our view, it obviates the need for any outsized rate cuts going forward. In that sense, the data is consistent with our view that the Fed will now ease in increments of 25 basis points.
Number 2, Bansi says markets have now reduced their expectations for the Fed's next cut in November.
Following the data, markets pared down expectations of 50 basis point move. Currently, markets are pricing 25 basis point easing for November and December meetings each, and around 150 basis points of easing in the next 12 months.
The US dollar index rose around 0.5%, which saw the Aussie dollar close down at 67.96 US cents. It had been 68.43 just before the jobs data came out. The Kiwi dollar also fell, closing at 61.58 US cents, down from just over 62 US cents before the data. Number 3, the Reserve Bank of New Zealand is now expected to cut 50 basis points when it makes its decision this Wednesday. Here's ANZ New Zealand Chief Economist Sharon Zollner.
So our expectation now is that the Reserve Bank will take what's on the table, deliver 50 next week, but nonetheless reiterate that the path from here is highly data dependent. The same way the Federal Reserve in the US did. They managed to pull off a hawkish 50-point cut. They managed to deliver 50 but prevent the market from assuming that 50s were going to be the default from then on. That's a tricky thing to do, particularly since the market really is of a mind that rates are going to go lower faster than the Reserve Bank or economists are expecting. And so far, they've kind of been right, so it's hard to argue with it.
Number 4. Sharon says the NZIER's quarterly survey of business opinion published last week was instrumental in shifting economists' views from a 25 basis point cut to a 50 basis point cut.
What that survey did show is that capacity is definitely opening up very rapidly in the labour market, and the pricing intentions in that survey dropped very sharply. Now, they have dropped in our own survey too, but they've been a bit stickier. But this survey was suggesting that actually they're lower than they averaged before COVID. So if the Reserve Bank takes that at face value, then they really can conclude that, okay, they've done enough. And if they think that neutral is sub 4%, then why would you keep the OCR over 5 for longer than necessary?
Number 5. So what happens to the New Zealand economy if rates are cut 50 basis points? Here's Sharon again.
We've already seen the housing market perk up quite sharply. The proportion of houses that are successfully selling at auction has lifted pretty dramatically. We've seen a surge in business confidence and in businesses' expectations for the future. But if you're confident that there's a lot of spare capacity in the economy and that wage growth is going to remain fairly subdued and that the economy here and now is really weak, then even a V-shaped recovery wouldn't necessarily threaten the disinflation that's in train.
Sharon Zollner there. Now, in our bonus deep dive interview, I spoke to ANZ Head of Australian Economics, Adam Boyton, about an unusual shift in workforce participation in Australia and what it means for interest rates.
Now, typically what happens is if the unemployment rate's rising, workforce participation falls because you get what's called a discouraged worker effect. But interestingly, and over the past year, not only has the unemployment rate risen, but we've also seen a higher participation rate. Indeed, the participation rate has risen 0.4 of a percentage point over the past year to a record high of 67.1%.
And is there any particular standouts, either by age group or by gender?
What we see when we delve into this by age cohort and by gender is firstly, female participation has risen much more than male participation. And secondly, when we're looking at changes in participation rates over the past year, we're seeing a substantial or a noticeable increase in participation for those aged over 60. And this is really interesting because what it tells us is that there's probably not one simple explanation for the increase in participation rate. So it's not, for example, students, or it's not, for example, just skilled migration, because if that was the case, of course, you wouldn't be expecting to see such an increase in participation rates amongst older Australians. So it looks like an increase in labour force participation is reasonably broad-based, and there's not just one thing driving it.
And what are the implications for monetary policy in the long run of a continued increase in participation?
One of the interesting features of the Australian economy over the past few years as we've come out of the pandemic is that labour supply, so for want of a better phrase, labour force participation, has risen in line with that incredible demand for employees. And that's actually a really helpful thing for monetary policy. If you have the demand but supply doesn't respond, then that means everything else equal, higher inflation and higher interest rates. So the fact that we've had such an enormous response by the supply side of the labour market, that is that increase in labour force participation, has probably been helpful in allowing the Reserve Bank to keep the cash rate in Australia a little below where we saw some of those peaks globally. Now, that wouldn't be the only thing, so I don't want to overplay the importance of just this one thing, but I think getting that labour force or that labour supply response has been really quite important. And if you step back, I think it also says that maybe economies adjust and they're a bit more dynamic than what people think. Indeed, Bernard, it surprises me in a way that we're getting record participation rates now, because if we jump back, say, 15 or 20 or 25 years when we first started to think about the ageing of the population, all of those really long-run estimates of labour force participation were that the participation rate should be trending down now as the population ages. And so that's another interesting thing we're seeing in these data, that as we, I guess, have longer, healthier lives, people aren't exiting the labour force at the ages they used to. And that just tells us often, I think it just reminds us that economies adjust to the circumstances around them and they're not just always entirely static.
And just finally, the one sort of standout age group was 20 to 24, seeing significant reductions in participation, particularly for women. Any thoughts on that?
What could be driving that is a return to in-person or face-to-face attendance at educational institutions. It's hard to be definitive about that, but that would strike us as perhaps one of the most likely reasons that you've seen that. I don't think it's because the labour market is particularly weak for those people. We have seen a bit of an increase in youth unemployment, but I suspect an increasing return to face-to-face in-person attendance at educational institutions could also be a factor here.
Adam Boyton there. That was 5 and 5 with ANZ for Monday, October the 7th. Catch you tomorrow with more analysis of those strong US jobs figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.